This is Mark Sobel, U.S. Chair, OMFIF. Today, I'm delighted to be joined by a first-rate panel and a group of former colleagues to discuss current financial stability risks and the policy outlook for the U.S. Financial Stability Oversight Council and the Office of Financial Research as a new administration takes hold. Our panelists are experts. They have worked in the trenches of government and have valuable insider and outsider perspectives on policy priority, strategy, and getting things done. Richard Berner will lead us off with a presentation on U.S. financial stability and thoughts on directions for the FSOC and the OFR. Dick is a professor in the Department of Finance at New York University Stern School and co-director of the Stern Volatility and Risk Institute. I should add the Institute's webpage is well worth a visit, and especially the VLab page. Dick was the first director of the Office of Financial Research from 2013 to 2017. He was a counselor to Secretary Geithner from April 2011 to 2013. Before that, and even before that, he was a longtime head of global economics and a U.S. economist at Morgan Stanley. And on a more personal note, besides his brilliance and outstanding credentials, everyone who has ever worked with Dick knows him as a wonderfully kind and collegial colleague. I'm very deeply honored to be joined by Mary Miller today. She's going to focus on the FSOC, I hope. Mary joined the Treasury early in the Obama administration as Assistant Secretary for Financial Markets and then served as Undersecretary for Domestic Finance from 2012 to 2014, a role in which she was responsible for developing and coordinating Treasury's policies and guidance in the areas of financial institutions, financial regulation, federal debt financing, and capital markets. And she also oversaw the FSOC. Trish Mosser will be our other discussant and hopefully will offer us detailed insights on the OFR. Trish is director of the MPA program in Economic Policy Management at Columbia University School of International and Public Affairs and leads the school's initiative on central banking and financial policy. She served with Dick on the OFR, heading its Research and Analysis Center, and she spent 20 years at the Federal Reserve Bank of New York, where she was a senior manager at the Fed's open market desk. So I'm going to turn it over to Dick. We invite audience questions. There should be a chat function. I'm probably going to handle the questions. I urge the audience to keep the questions short. Dick, the floor is yours. I hope you'll give a plug for your institute and tell us about the key financial risks as you see them, and talk maybe perhaps a bit about non-bank financial intermediation risks and the Biden's team interest in looking at climate finance and risks, as well as any general thoughts you have on FSOC and OFR going forward. Floor is yours.
Well, thanks so much for the opportunity, Mark. It's a great pleasure to be here and to share the screen with Mary and Trish, wonderful former colleagues and constant friends. We always enjoy talking among ourselves, and we are greatly honored to be here today. So let me start just by saying the financial crisis underscored the realization for all of us that a system-wide approach to financial regulation was necessary. Specifically, it's critical to think broadly of where vulnerabilities might exist in the financial system. And we've done a lot of that. Shocks that expose vulnerabilities could threaten financial stability, which is the ability of the financial system to function even under stress. Now, the post-financial crisis program of reform that in the United States was specified in Dodd-Frank did increase the system's resilience to shocks. But the program was incomplete, partly because banks were the prime focus. So while banks fared well following the shock from the pandemic, that shock exposed vulnerabilities elsewhere in the financial system. So let's ask what those vulnerabilities look like. Well, we had a period of very low interest rates and reaching for yield, appropriate for monetary policy, but they increased corporate leverage dramatically, and securities financing transactions and the markets are still runnable and vulnerable. The shock exposed those vulnerabilities, promoting default risk and a massive liquidity squeeze. Pro-cyclical vulnerabilities in what is now fashionably called market-based finance amplified the shock. And I should say, pro-cyclicality is the tendency of the financial system to amplify and spread shocks when they first occur. And that's both because of the nonlinearities and spillovers from the economy to defaults and the feedback from credit to the economy and vice versa. So that's why the Fed responded as never before with backstops to facilitate market functioning and programs to limit the adverse consequences on asset prices and the supply of credit. But I'm concerned that that response has created the unhealthy expectation that the Fed will always be there to limit the effects of shocks on asset prices and also the economy. So I think we need to make the system and its components more resilient. Now, to step back, certainly it's good that we have a diverse financial system that includes insured depository institutions or banks and deep capital markets. While the banks are prudentially regulated, however, they're not invulnerable, and we should be strengthening the bank regulatory regime in certain ways. Capital markets are also more resilient than prior to the financial crisis, being somewhat less reliant on short-term runnable wholesale funding. And central clearing has mutualized counterparty risk and increased transparency in OTC derivatives markets. But they aren't invulnerable either, far from it. And I should say, in terms of full disclosure, I serve on the CFTC's, the Commodity Futures Trading Commission's Market Risk Advisory Committee to look at some of these issues. And more work is needed. And increasing banking resilience and banking regulation has fostered regulatory arbitrage and a migration of activity into the shadows. Now, after the crisis, I think we should have thought harder about how and done more to make our systemically relevant markets and non-bank financial institutions more resilient, including how to oversee and monitor them. We did do a lot of thinking about that, but actions seem to have been limited to just a few jurisdictions. In terms of FSOC, it is absolutely the case that the Financial Stability Oversight Council should be working to assess resilience in these markets and firms and to develop and adopt regimes to improve it. I think the financial crisis, as I alluded to earlier, showed how a piecemeal approach to regulation allows risk to slip through the cracks. So the Dodd-Frank Act established the FSOC to take a broad view of the entire financial system, to assess risks in both banks and non-banks, and the activities in which they engage. Doing so requires examination and oversight of both. And I think it also requires better and more comprehensive data on both. So that is obviously a role where the Office of Financial Research can play a part in helping to do that. One specific issue I think needs to be reversed. That is, in 2019, the FSOC proposed to raise the hurdle for enhanced supervision of large, systemically important non-bank financial companies, or NBFCs, far too high. It remains the case that we're not sure how systemically important these institutions might be, but further analysis is needed. But as a result of this, it would focus almost exclusively on the financial activities that could threaten financial stability and not on the firms that would engage in them. Now, I applaud identifying and examining such activities, but I think risk assessment should begin and end there. I'll close by talking a little bit about emerging risks. And in the Volatility and Risk Institute, we're focused a lot on looking at climate, pandemic, geopolitical, and cyber/operational risks, and trying to think about the interplay among them. And we're in the foothills of doing that. As you all know on this panel, and I'm sure most of the audience knows, these things are hard to measure and hard to analyze. But that doesn't mean we shouldn't try. Because in the case of climate risk, I think it's now being increasingly accepted that climate risk is investment risk and is financial risk. And it's a good thing that central banks and other authorities are now starting to focus on that as never before. But we need better information on how to measure these risks and how to think about what the analysis of those risks should look like. The time is obviously now to get started on that program. I'll leave it there.
Well, thank you for that. Perfect segue into Mary. I'd be curious to know what thoughts you have to offer the Biden team on the FSOC. Dick already alluded to it. I saw this issue of non-bank financial intermediation. Bill Dudley recently was quoted as saying the FSOC is supposed to identify and address stability risks arising in the non-bank portion of the financial system, but has failed to do so. It's interesting. The Fed oversees banks and they've been more resilient, but some of these areas are outside of the scope of the Fed and fall under the domain of the FSOC and the SEC and others. You dealt with these issues firsthand. So perhaps you can tell us about the FSOC, its strengths, weaknesses, where you would like to see it go, and whether you think the other agencies really want to play ball with the FSOC.
Mark, thank you for hosting this today and for the great question. The FSOC is a fascinating topic here, and it's particularly important to think about it in the context of the new administration. I would say any organization is always going to be as successful as the leadership. And I think with FSOC, it really matters how much interest the leaders take in its mission, how much understanding they have of the powers of the FSOC that are laid out in the Dodd-Frank legislation, and what kind of agenda they want to set for it, because there's a lot you can do with FSOC. It is clearly important. It is the first title of the Dodd-Frank legislation, and there are sweeping ambitions for FSOC. I would say it is not yet fully delivered on its promise, and it really does matter who's leading the FSOC and how they make that organization work. Let me digress just for a moment for the listeners to say that there are some things about FSOC that I think are awkward. There's some things that I think offer great value. And it's really going to come down to how do you make this work? If you think about the structure of the FSOC, there are 10 voting members. So the 3 banking regulators, the 2 securities regulators, the Treasury as the chair of the FSOC, and then some new members that were created now going on 10 years ago. The new head of housing finance regulation, FHFA, the CFPB, the Consumer Finance Protection Bureau, is a new FSOC member at the time. There is an insurance expert in an effort to bring insurance under the umbrella of this broad group of regulation. And the credit union head, the NCUA. So you have those 10 voting members, and then you have an additional 5 advisory members. You have 3 state regulators in the fields of banking, securities, and insurance. And you have the new head of the Federal Insurance Office that was set up at the time. So I was there at the beginning and the opening days of FSOC, and I think the awkwardness had to do with suddenly bringing all of these entities together, many of whom had not worked together in the past, and creating this sort of 2-tiered voting members and non-voting members, which to me, I always thought of as the varsity and the JV. And how did they work together, and how valuable was it to have all those parties in the room together? And I'd say there was great value in sort of lifting the playing field in terms of general observation and understanding, and beginning to have conversations about systemic risk. But I'd say it was an unlevel playing field, not just in the voting arrangements, but also in the sort of level of knowledge and awareness and day-to-day working relationships that some of the parties had and others didn't. So really trying to make the FSOC work as a group was difficult. And there was a tendency that I think is still true today to revert back to an older format of the President's Working Group on Financial Markets that had existed in the 1990s and early 2000s, which is a smaller group of the Fed, the SEC, the CFTC, and the Treasury. And I think the challenge for the head of the FSOC is to really make sure you get everyone to the table, everyone in the room, so it doesn't break down into smaller subsets of the FSOC. I'd say a couple observations I have about that time is I would suggest that in the early years of the FSOC, we did not fire on all cylinders. We didn't use all of the authorities that were laid out in Dodd-Frank. I think we spent a lot of time on the non-bank designation work, which was really hard, and not enough time on the regulatory coordination work, which is so important. Because if you can do that, if you can make FSOC the trusted, credible forum for coordinating regulators, getting better regulation because of more insight and more understanding of the whole landscape, that would be a real home run for the FSOC. I would say one of the values I saw in it was just, the building of those relationships. When we went through Superstorm Sandy, I think it was in the fall of 2013, but the entire East Coast was shutting down. And we did not have to run through our Rolodexes trying to find out who to call and who to reach out to. We were able to convene on a moment's notice every single party that had a role in keeping things on track. And I use that as an example of saying you want a standing body where you can instantly bring everyone to the table. If you have a market accident, if you have a climate accident, if you have a risk of any kind unfolding, the FSOC is a great body to have standing up and ready to go. I could wax on about some of the areas of risk that we talked about: activities-based risks versus entity-based risks, money market funds. We did exercise a piece of Dodd-Frank with a Section 120 recommendation where all of the regulators made a joint recommendation to the SEC about strengthening money market funds. So we were testing the pipes. We were trying to figure out what the authorities of FSOC were and how could we use this body. I'll close by saying that I think in recent years, the FSOC has met less frequently, has been used less productively, I think, to do some of the work that it can do. So my message to the Biden agenda is you have a great tool here. It will be as good as you make it in terms of convening, of discussing, of identifying systemic risks, and really using that group as a very important voice for the United States on all types of risk in the financial markets and addressing them. So let me stop there. I could go on and on, but thank you for that question.
Well, hopefully we will get you to go on in a bit. Your remarks about bringing everybody together reminded me of the G20, which was really valuable in getting us to know all the emerging market officials and knowing who to call when there was a crisis. But Trish, could you please share with us your thoughts on the OFR and what the new administration might be should be thinking about doing?
Certainly, I'd be happy to. And thank you, Mark, and thanks to ANFA for inviting me. And of course, it's wonderful to see Mary and Dick today. So I want to make, I think, 3 points about OFR, and they relate to a number of the things that Mary and Dick said about FSOC. So I'll try to relate them back. The first is a structural issue. Mary talked about structural issues with FSOC. OFR has them too. And OFR, for those of you who are less familiar with it, has really a dual mission. I mean, and this is in the law. The first is to support FSOC with its data needs, providing analytical expertise as well, if needed, so forth. But it has a second mandate, and that is to be an office of technocrats, to be an office that collects and collates financial data, that sets data standards for the whole financial system. And last but not least, to provide an independent voice on financial stability research and risks. Very explicitly, the OFR has its own annual report, separate from FSOC's annual report of financial stability risks. There's a tension there. It's very sensible to put OFR in the Treasury Department, which was the decision that was made in Dodd-Frank and close to FSOC. It's completely sensible, and it's really, really great for the first goal if it's used properly. But it creates real frictions in the second. The US Treasury is the policy voice of economic and finance for the current administration, whoever that may be, in promoting their policies. It doesn't really have a history in terms of either, at least a recent history, in terms of data collection or having an independent public voice within its walls. And to say that would sometimes create a culture clash is true. And a real culture clash last in the previous administration, but throughout its history, it's been a tension. The second structural thing is the OFR is not really a statistical agency. I think most people think that it is, but it's not a bureau. The good news is it has a lot of budget independence, and so it can pay for the things it needs to do. But in other ways, it really can't completely go its own way. The way, for example, the Bureau of Labor Statistics can in gathering data, or even the regulatory bureaus like the OCC. And this is particularly a problem with respect to data sharing. One of the goals of OFR was to gather data and then make it available elsewhere. And the problem is, if anybody misbehaves with OFR's data, it's got no enforcement powers whatsoever. So it's a little bit of definitely a problem, and it restrains what they can do. And the last one, with respect to data, OFR can write rules and subpoena data from the private sector, but frankly, it's kind of fuzzy about its ability to do so with its peer agencies. It really can't mandate agencies use its standards even that it sets. And the legal entity identifier is a great example of that. And that's a problem. And it relates a little bit to a point that Mary made that about the FSOC, is that this whole group, gets in a room. All of these agencies cooperate on are supposed to cooperate on financial stability and with the OFR on data, but there's sort of not any way to truly push them to do that bluntly. They can't. The OFR doesn't have powers to compel, I guess, and the agencies, many of them, despite being on FSOC and working with OFR, actually still legally don't have financial stability in their mandates of the individual agencies. And that creates a certain amount of tension sometimes. Second point I want to make is about speed. The Trump administration just slashed the OFR, slashed the staff to the extent that they could, slash the budget, actively encouraged a huge proportion of the employees of the office to leave, and set it back years. That's a big problem for a largely data and IT shop. I ran the research function, but that was the minority of the OFR. Most of the OFR was about the data shop. And being 4 years behind in the world of data management and data science right now is an entire generation. The world has completely changed in the last 5 years in terms of data management. And so the OFR is going to have to hit the ground running when it goes. And I want to really, really reinforce Mary's point that it really depends on the most senior people. Leadership is policy here. And I think the OFR's ability to do that is going to very, very much depend on both who is in charge of the OFR, but also who is responsible for FSOC and the priority that they put on those things. And they do need to speed things up. OFR does. And I'll be a little blunt based on the experience prior to the Trump administration, which is when I was at OFR. It's possible we have to be a little less, the OFR needs to be a little less nice. Sorry. And a little pushier, maybe, about a few things. Particularly, and here I'm going to say, particularly on the kind of unsexy things like data standards that are really nuts and bolts of how you get good, consistent data across the financial system so you can really assess what's a financial stability risk and what is not. Now I have a big but to that though. And the big but is this. For all that I think speed isn't going to be important, I think the expectations for how quickly both FSOC and OFR could seriously stand up an infrastructure to do what the law wanted, most of those expectations are quite unrealistic. And I'm going to give you, it takes time to do this, a long time to do this well. And let me give you a very quick historical example of that. GDP, the National Income and Product Accounts. When was the first time there were national income accounts done? They were actually done systematically and with some regularity by the NBER in the early 1920s. So it was realized after the First World War that that was when they started. The FTC actually gathered a whole bunch of data and started to do this in the 1920s. And guess what? At some point, Congress just eliminated the budget for it. Does that sound really familiar to people? And they just stopped doing it in the 1920s. Of course, the process got going again, famously with Simon Kuznet's plans in the early 1930s in the Department of Commerce. And that eventually bore fruit, of course, and he won the Nobel Prize for it. It was successful. It's what we know of as GDP and the national income and product accounts. What year was the first systematized public release of the national income and product accounts? 1947. That's a lot of time because it takes time. And it was not a technology question. Obviously, the technology to do all this was completely different back then. This was it takes time to get the consensus and the people and the data and the methodology right and test it and go back and do it again. So I think more realistic expectations that will help. Let me finish with a couple of thoughts. Excuse me. About agenda. I agree with what Dick and Mary said for the most part about both the OFR and the FSOC's agenda. First, you do have to look at both systemic risks of institutions as well as activities, and I think. And on the activities part, that actually seems to be an area, if FSOC's going to pursue it, where the OFR has a big advantage because it can get data from the entire financial system, banks and non-banks. And particularly on things like short-term funding risks. We had a great demonstration of non-bank short-term funding risks still being a problem. Look at REITs and a certain subset of hedge funds last spring. We're definitely had very serious funding problems and created issues in repo markets and elsewhere. As Mary well knows, the regulatory part of activities is thinking about regulation of systemic activities is trickier business than the data part, but I think they could make progress on that if they wanted to. On the climate side, I agree that the FSOC needs to start to pick that up. I think there's a question of what they want to tackle because it's an enormous topic and they have a lot of other things to stand up to. And it's not that they shouldn't do it, but where to focus. And it seems to me that the impact of financial stability and on financial stability of legacy assets, really large catastrophic events to the financial system would seem to be a place to start to me. And getting some additional information and particularly standardized information would be helpful. And on that, I'll stop.
Well, thank you for that. I noticed that all of you kind of reference non-banks and the activities regulation. I appreciate the focus on activities, but I never really understood how the FSOC and others implement activities regulation. Is there any there? Are they actually looking at something, and how would they know, and do they have metrics? That's an important issue for non-banks. And I guess, there's the issue of fintechs, which is arising. I was wondering if you had any thoughts on any of that.
Well, I certainly do, Mark. And so I'll jump in. On activities, I think one of the things I mentioned was a focus on markets, and particularly markets that I termed systemically relevant. In other words, those markets that are really critical for the functioning of the financial system, like, as Trish alluded to, repo markets and related financing markets. And so, to be very specific, we saw in this latest shock that in spite of the fact that we had some regulation related to money funds, which are activities that go across a range of different kinds of institutions, that those funds proved to be vulnerable in the shock. And as a result, the President's Working Group issued a report in December of last year saying, here are possible reforms to this area of financial market functioning that are still lacking in resilience. And so to look at a specific area like that, I think, is useful because it does affect broad swaths of the financial system, both with people who supply liquidity and people who demand liquidity. And those, so you have to look at both sides of the equation there. So I think a focus on things like that can be helpful in looking at activities. Likewise, where there's a blurring of institutional siloing and different kinds of firms are offering similar activities, I think it's useful to look at that. So systemically important markets, repo markets come first to mind. There have been a number of proposals to make repo markets more resilient, including first, as Trish mentioned, better information, better data. We do have more data than before, but we still lack data on certain parts of the repo market in the United States. And then thinking about how we might, and if we should have more backstops for those markets because they are runnable inherently. And what should those backstops look like? And how should we look at a variety of regulations and features in a variety of institutions, like the supplementary leverage ratio in banks and other things that might be impeding the flow of liquidity from one part of the system to another. And so those things are, I think, aspects of that. I'll let Mary and Trish jump in, but if you want to come back to fintechs, I'm happy to do that too.
Sure. Maybe I'll come back to you, Mark, on the, what is activities-based? What are the risks there, and is there a there there? And there's definitely a there there. And regulators tend to regulate entities. They regulate specific companies and entities that fall within their jurisdiction. But it's often the case there are activities that entities are engaged in across the financial system that pose risks that are not going to be picked up by an individual company or regulation of that company. I'll use the example of asset management companies. Asset managers may offer mutual funds with daily liquidity. With the evolution of the business and the products, you can start introducing mutual funds that invest in highly illiquid things, but are offering their shareholders daily liquidity. That can blow up into a big problem in a market crisis. So I think it's entirely within the purview of a group of regulators to think about that. How much liquidity are we promising that we may not be able to deliver that could prompt a market crisis? So that's sort of a broad activity that is worthy of thought. Another might be if asset managers all use the same custodians and how much risk is concentrated in that practice. That was the sort of thing that we talked about when I was at the FSOC. So I think it's really important to have some venue where you can think broadly across the landscape of activities that may be introducing risk. And there are lots of things that are outside the banking system that are worthy of that thought. I was reading something recently about market indexes. We're moving to a very big investment in passive investment vehicles. They are highly reliant on the indices that underpin them. But there's never been a lot of attention paid to how are they built, what's in, what's out, should Chinese A shares be in or out, or when and how, over what body of time should they be built into an index of international security. So there's lots of scope for thought about these things. And it doesn't have to land in regulation always. Sometimes it's just putting some daylight on something that deserves more attention and thought that's going to change practice. So I'll pause there, but that would be one of my observations. I think activities-based work is quite relevant.
So just to interject, I totally agree with you. My there was more that I've heard people talk about the need for activities-based regulation, but I've never understood what that concretely meant or whether there were concrete plans and details about how to interpret activities-based regulation into something that had outputs when necessary. Trish, would you like to add anything?
Yeah, sure. So one very quick observation on what Mark just said about activities-based regulation. When the activities are in a kind of pretty defined market, then that is easier for the regulatory world to get their hands around. I mean, after all, we regulate equities no matter markets, no matter who you are. We regulate futures markets no matter who you are, derivatives markets no matter who you are. And there are certain markets and certain places with pretty significant liquidity risk. Mary mentioned a couple of them. I thought Dick's comments, particularly about repo and securities lending, which are pretty closely related to each other, are good ones because we know they're runnable. And we also know the breadth of types of financial institutions who participate in those markets is enormous. Insurance, asset management, hedge funds, banks, broker dealers. Anyway, we could go on. It's a long list. So that seems like a place where there is sort of a defined market, and you think that market or a set of products has very specific risks. Then you can think about that more concretely. It's harder when you're worried about concentration risks and a couple of the other examples that Mary gave, I think particularly with respect to understanding the operational risks of having, very few custodians and that sort of stuff. That's a little harder, I think, to get your arms around the kind of what do you do about this problem. I do want to mention one thing though that Dick mentioned backstops, and I think this is one of the places where the rubber really meets the road with respect to concerns about how comprehensive either regulation or backstops are. Traditionally in the United States, backstops are done to entities, not to activities. Except, of course, in true extremis, we know the Fed in particular extended liquidity facilities to lots and lots of different types of firms, which it has the complete emergency authority to do. But by doing that, it raises the question of whether that just is going to make the incentives for regulatory arbitrage in the future even bigger. If you do that again, which of course the Fed, in response to COVID and many other central banks around the globe had to do, then you sort of reinforce that. And so I think the real deeper argument for activities-based, at least considering trying to level the playing field for certain types of systemic activities in a better way, has to do with how you view bailouts and backstops. In my personal view, that's an area where a lot more work could be done. And
Mark, if I could, sure. I'm sorry, if I could just jump in. Mary, were you going to go ahead?
Go ahead.
So just to sort of complete the circle on some of the things that we've talked about, in our balkanized, fragmented regulatory structure, even though we have the FSOC to try to solve that collective action problem, as Mary noted and Trish noted, I think it really depends on leadership and a commitment to bring the entities who are regulators together and to get them to focus on a common goal. And the, Title I of Dodd-Frank spells that out pretty clearly, but really people have a tendency to revert back into their previous shell and to revert back into their statutory authority. And so we don't have a mandate for financial stability or even to look at things outside their specific purview for the market-based regulators, the SEC and the CFTC. Now, some of the regulatory heads of those bodies have embraced more clearly things that relate to financial stability. But not having the agreement, not having the commitment, in spite of the fact that you now have a Rolodex and you know who to call when things go bad, it would also be good in peacetime to know who to call and to get together to say, let's work together so that things might not be so bad the next time a shock hits and exposes vulnerability that we all know about, but which we haven't done much on.
I think that's a really good point. There is a opportunity, as Dick says, in peacetime to try to think ahead and get ahead of problems that might develop, but it's hard to get people excited about things that are not crises. But that is a really important point.
Well, thank you. That's a very good, clear message all of you have offered. So, Dick, you said you'd be happy to talk about fintechs, and the other issue I had, another issue I had on my list pursuant to your opening remarks was CCP resilience. And I noticed the DTCC yesterday was suggesting that the settlement period be shortened after GameStop. So I throw the floor on Fintech and CCPs to whoever would like to talk about it.
Well, since you fingered me, Mark, I'll be happy to start the conversation. On fintech regulation, just as with other regulation, we have to think about why we regulate and what things we might want to regulate, and that's typically where markets fail, and where we have to protect people who transact in financial markets and with financial institutions in the financial system from harm that might accrue to them, whether it's consumers or investors or issuers of securities. And we also have a commitment, I think, in regulation, which is enshrined in the SEC most prominently, to assure market fairness and integrity and market functioning. But what we've learned, I think, in the financial crisis is this really is a team sport. It requires not just the SEC, which has limited authority to do some of those things, but it requires cooperation and collaboration with the other financial regulators. And, as we looked at our structure, speaking of structural problems, often comparisons have been made between ours and the one that has evolved in the UK. And even though it's a smaller country, it has a very large, still has a very large, even post-Brexit financial system, many times greater than GDP in that country. Still has a lot of financial activity. And so they have a real stake in making sure that it works right and that those markets have integrity and function well. So having laid out some of the purposes of regulation, then we have to say, well, is fintech just, the same old stuff in new wrappers? And the answer is no. There are certain characteristics of fintech that are different. There are some that are the same, where you can think about what we've done in other respects. The things that are different clearly are speed. It's much quicker than traditional intermediation or transactions. And some of that's just the result of technology, but it's also footloose. And so if we think about regulations that might apply to a certain jurisdiction, with fintech, it doesn't have any real boundaries. So how do you regulate? How does a state regulator, for example, think about regulating fintech when the fintech company and the fintech activities might spread across jurisdictions, as they surely do? And the answer is you have to have more cooperation. You have to have or try to achieve a level playing field in that regard. So one aspect of fintech, for example, is identifying who's transacting with whom. Trish talked about entity identification with the legal entity identifier. Do fintech companies, are they required to use identification systems? Do we have digital IDs for everybody where regulators and supervisors can understand what's really going on in fintech activities and to identify where there might be problems, whether they're sort of micro type problems or whether they might spill over into the financial system as a whole? Those are some of the issues we need to think about, the ways to do that. I'll mention in this connection the chorus that emerged with Libra to have a central bank digital currency that was accompanied by accounts for everybody or many people at the central bank, and having a digital representation of a security, in other words, a token, might be a good thing and might help speed the process of financial intermediation of transactions, all the payment, clearing, and settlement activities that are the plumbing of the financial system. But of course, if you couple that with accounts at the central bank, then in wartime or stress periods, it may be the case that people run to the central bank and disintermediate the entire banking system, because I'd much rather be doing business with the central bank than with some institution that might not be around in a stress period. So that's one problem that has to be addressed. But it doesn't take away from the benefits of using technology to speed up the process of transaction. Now, clearly, we've done some of that. with different payments vehicles that have made things much more attractive. The world has benefited from, in terms of financial inclusion, from mobile payments. And all those things are great, but we need to think about whether or not they pose risks to either individuals or actors in the financial system, or to the financial system more broadly. In other words, what happens when bad things happen? Trish and I have both thought about cyber risks a lot and operational risks. So it probably went unnoticed the other day that, I think it was yesterday, that Fedwire went down for a few hours. Well, Fedwire, a lot of people don't know anything about it, but it is a key payments vehicle for transactions in our financial system. And if it were to go down for more than a few hours, it might bring the financial system maybe not to a halt because there are alternatives, but it would really slow it down dramatically and create enormous problems. And people would start to think about, am I going to get paid? And when? And what's that's going to look like? So we need to have a lot of resilience in our systems, our payment systems, and our clearing and settlement systems as well.
So I'll echo that. I think it's really important to constantly be reviewing the basic infrastructure of markets and all the things that happen behind the scenes that make things work, and worry about what happens if something goes wrong. I was going to just also add a word on fintech, which is, I don't want to discount the importance of innovation in financial markets and the role that financial technology can play in helping some of our largest institutions modernize and become more efficient. And I'd say that if we have sort of a sandbox of fintech companies that are testing new ideas and trying things out, that's a good thing. They're generally small. Failure does not put the whole system at risk. And if they're generating ideas that can be adopted by larger institutions, or even perhaps they'll be acquiring some of these fintech companies to help them innovate. That's, in my book, okay. The risk arises when a fintech becomes too big and they're operating without the traditional protections of the banking system. If you have a lending operation that really doesn't have balance sheet, doesn't have capital that can backstop credit risk, that's a problem. So I think the challenge is to be watching these things, recognizing the strengths and the value they can bring to markets, but also paying attention to size and scale and emerging risks. What happens when let's say a lender gets into trouble outside of the banking system, is they quickly realize they don't have the protections of things like FDIC insurance. They don't have the protections of capital requirements. They don't have the oversight and the protections that are enjoyed by larger financial institutions inside the perimeter of regulation, and that usually ends unhappily. So I think the challenge is to sort of balance the role of innovation and also the importance of regulation at the right time, at the right scale, in the right place.
Trish, can I tempt you on CCP resilience?
Oh yeah, you should ask Dick that question, but he's
being shy.
He's being shy, I can tell. So what I know about CCP resilience, I learned from Dick and a few other people, but yes. So first, this ranks, it's actually a very parallel set of points to a couple of others that we've met. First of all, CCPs for standardized products greatly enhance efficiency and they reduce risk. Multilateral netting is net a big plus in anybody's book. So let me state the obvious right up front. Generally speaking, if it's possible, and it's possible to do particularly at scale, it's really net lowers risk in the financial system. But, because there's always a but. But it is an economies of scale business. It is, truthfully, CCPs are natural monopolies, to use the economist term, which means you're not going to have very many of them. And you probably don't want them to compete anyway, because then they would compete on risk, which is generally not smart. And given that, you have tossed all your eggs into one basket, which means you better watch that basket incredibly carefully. And my concern about CCPs is that they are kind of public utilities, like electricity. And they're not completely yet, in my personal opinion, quite gotten there in terms of their regulatory oversight. They are certainly for-profit companies, which is fine, but their own resources, not just their members' resources, but their own resources are not particularly large, particularly if there were a major liquidity event. Now, I don't think anybody thinks that a CCP isn't too big to fail, but they probably are. But I am concerned about the balancing act between regulatory oversight and also peacetime, wartime, planning in peacetime. If something goes wrong, exactly what are the mechanisms that the public sector can both do that would be effective, and what implications does that have for the way the firms operate on a day-to-day basis in peacetime and in crisis time. And with that, I'll stop and let Dick correct me.
No, Trish is 100% right. I just add a couple of things. One is when we look back at the shock from last year, and everyone anticipated there might be problems in certain institutions in the financial system, CCPs among them. Well, as luck would have it, there weren't many problems. There were problems in markets that clearly surfaced, but it looked like the CCPs sailed through the problem without any major problems emerging. Certainly none went bust. There weren't major defaults. Clearing members also did pretty well, and the process of clearing went reasonably well. So I had a conversation shortly after that with a Federal Reserve official, and I said to him, so how do you think the CCPs stacked up in this crisis? And he said, well, I have no idea, because we threw everything but the kitchen sink at the problems that we encountered. And so I really can't tell you whether or not the CCPs are really resilient or not. And that's been a comment that I agree with. But what we do know is, in thinking about stress testing CCPs, which we need to do more of, and in which colleagues and I have written about, I think we need to think about exactly how we're going to stress test these organizations. And what about the connections with their clearing members? And what kinds of shocks are they going to go through? Clearly, market shocks are the big deal for CCPs, but operational resilience is also, as Trish mentioned, I think an enormous problem. And if something were to go wrong operationally at a CCP, then, and securities don't get cleared, transactions don't get cleared. So, clearing is great. And in fact, it's been recommended that we have central clearing for repo and treasuries, and I think those are good things, but we darn well better make sure that the institutions that are doing the process are pretty resilient, and that we do watch all the eggs in that basket.
Great, thank you for that. We are running out of time, so let me try a lightning round approach to a question or two. Banks, non-bank interactions, FSOC, is there anything in that space that needs attention?
Well, I just comment briefly that, banks increasingly are enormous players in capital markets. The institutions we think of as banks are, complex. They are global. They are diverse. And, parts of those institutions look like other institutions. And banks are traditionally viewed as suppliers of liquidity. But what we've witnessed in the latest shock, in the pandemic shock, was they were pretty reluctant to use their balance sheet or other resources to provide liquidity. And that's what we talked about, having the Fed step in and really provide that. So the interaction between banks and capital markets is an important one that we need to look at as we think about the resilience of the system as a whole. Many so-called banking institutions have prime broker operations, which are quite profitable, where they engage with hedge funds. And they watch those things pretty carefully, but As Mary indicated, in asset management, you could have situations where the asset liability mismatch or the liquidity and maturity transformation could be great enough to promote some problems. And are the prime brokers prepared to do that? Do they have enough resilience? And are they watching their counterparties carefully? We could go on, but there are lots of interconnections.
So I might take your question in a slightly different direction, and I'm not sure what FSOC's equities would be here, but one of my pieces of advice to the incoming administration is to really take a hard look at the community development financial institutions, which I think can cover a lot of ground between a bank and ground level in terms of restoring more credit to parts of the economy that have really been left behind. And I think a CDFI is not a regulated financial institution, which gives it more running room, if you will, to provide different lending standards and to work with populations that have not been able to achieve credit and lending in the banking system. That should not be done without, oversight. I think there should be a lot of understanding of that, but I think we do have a huge need to try to equalize, the availability of credit across the economy. And I think these smaller institutions that are outside of the banking system could be important. And so, one of my recommendations to the incoming administration is really take a hard look at that space. I wish I had spent more time on it.
I would agree with Mary, particularly linking that up to the fintech. If you look at who took out loans in PPP, the conduits through which they used, it was an enormous expansion the minute they started to include non-bank institutions. They didn't for operational reasons at the beginning, but the PPP lending that eventually went through the non-bank part was very important, particularly for that segment of the business community, as the small business community, as well as for households. I think the international aspects of this, of banks versus non-banks, is important too, because we've talked almost exclusively about the United States, but the financial system's global. And the world is becoming the advanced economies are headed more in the US direction of, still larger banking systems in the US, but more non-banking systems, a larger part in non-banks and markets. And so this is going to become a theme important globally, I think. And getting in good information on that is a goal. The Financial Stability Board has laid it out. I hosted a conversation with Randy Quarles on this back in November. And he said, the data and analysis part of this is a huge challenge in every country, not just the United States. And it's going to matter what fintechs in different countries do, as well as what their banks do for the US itself.
Good. Well, I promised all of you you could leave at 11:59. It is 11:59. I want to tremendously thank you for joining us today and enlightening us. It was a fantastic and fascinating discussion. So thank you to all three of you, and it's an absolute delight to see you. Thank you.
Thanks. Thanks for the opportunity. Thank you.